Hello, and welcome to this Knowledge webinar. I'm here with Charlotte Ransom, the founder and CEO of Netwealth, and with Gerard Lyons, the Chief Economic Strategist at Netwealth. Now, Netwealth is a wealth manager which launched about, I think, 8 years ago.
That's right.
And I'm interested in this because with my pitiful amounts of money over the years, I've experimented with various wealth managers, and I can't say they've been brilliant at preserving my wealth. Mind you, I'm not very good at money myself. But what I want to know, Charlotte, is why I should put my faith in your company, in Netwealth, rather than the ones I've tried so far.
Yeah, thank you, John. Well, to give you a little bit of background, I was a banker for 25 years, and it was only after I left banking and
Goldman Sachs, is that right?
That's right.
Yeah.
And it was after I retired from Goldman, actually, and had some time on my hands finally, that I realised I'd done very little with our own money. And on the other hand, I knew an awful lot about the wealth management industry, and I was deeply sceptical, particularly about the fact that the industry didn't appear to have embraced modern technology at all. So what we've done with Netwealth very deliberately is keep the best bits of traditional wealth management, which is always the human bit, meaning the people who manage the money and the people who provide financial planning.
So your clients can actually talk to you sometimes?
Absolutely, that's right. Yeah. Expert humans sitting in the right seats, but at the same time using technology to do the heavy lifting. And what that means is that we are operationally much better, but it's a better digital experience for clients to the extent that's what they want. And it's much, much lower cost because we've been able to take out those additional costs.
Yeah, I like the sound of that.
That's why you should be thinking about Netwealth for managing your money.
Okay, well, we'll get into more of the details shortly. But first, how did you come across Gerard? How do you fit into this, Gerard? Do you want to tell us how you came across?
Well, I've had a very successful career in the city. So I was head of research and chief economist at a number of banks. Swiss Bank Corporation, I was chief UK economist. At Daiichi Kango, I set up international research for them. Then at Standard Chartered, the big international emerging market bank, I ran research. Then I spent 3 years working for Boris Johnson when he was Mayor of London. It was supposed to be a non-political role, but I was there for about 10 minutes and realised no one else thought it was a non-political role. But I played it with a straight bat. And when I finished, I was being tempted to go back into the city, into banking, heading up global research teams, but Charlotte and Tom, who were the co-founders, came along to me, and I thought this sounded really exciting. I thought there was a gap in the market, the product was really good, and the people seemed really up to it, and I did my homework on them, and then I joined in 2016 as a shareholder as well as the strategist. So it's been fun, interesting.
Well, there's a lot we want to talk about today. And we've had quite a few questions in from some of our readers, which we'll bring as many of those in as we can as we go along. But I think we should break this up and probably start with the macroeconomic outlook and then move into a bit more detail, having done that. So perhaps, Gerard, we should start with you. And I'm not an economist, and I'm not at all good on the economy, but things are not going very well as far as I can understand it. Maybe you put us in the picture about the UK economy.
Yeah, well, the UK economy, unfortunately, is a low growth, low productivity, low wage economy. In recent years, it's become a high tax and high government spending economy too. In fact, the four major economies of Western Europe, France, Italy, Germany and the UK are pretty much in the same boat, facing the same structural problems. On the positive, however, the economy has turned the corner in the sense that while it was very weak at the end of last year, it was very strong at the beginning of this, and the official forecast of the OBR expects the UK economy to grow close to 1% this year and 2% next year, as inflation stays low in the second half of this year and into next.
And you think that's going to happen?
Yeah, I think so. Yeah, so we're going to have a bounce. Inflation is coming down. That will boost real incomes. But the outlook for any economy, whether it's Britain or Germany or wherever else, depends on the combination of economic fundamentals, policy and confidence. The fundamentals are not great, but they're improving. The room for policy manoeuvre is limited, and confidence is often the most difficult thing to predict, business and consumer confidence. It seems to be improving at the moment. So we're turning the corner, but it's against the backdrop that's been pretty tough in recent years. But
we read a lot about the cost of living crisis, and also here we are in an election. People don't feel better off, do they? They feel as if they're suffering. And why is that?
Well, that's very important. Well, quite frankly, the Bank of England has made a terrible job of handling inflation. Now, on the positive, inflation is coming down, but the price level, the level of prices in the shops and everywhere else is still at a much higher level. So inflation in the next couple of months will likely be down to 2%, and the Prime Minister is making a big issue of that. But the level of prices is about 25% higher than a couple of years ago. And that's often ignored or missed out of the picture. Thankfully, at Netwealth, we've read the inflation picture really well in recent years. And about 3 years ago, we said, or I asked, which P is it? Is inflation going to pass through quickly, persist, or become permanent? Now, the Bank of England and indeed other central banks thought it was going to pass through quickly. They were wrong. Thankfully, we were right, but unfortunately, it was a case of inflation persisting, and it has done. But I don't think inflation is going to become permanent. And the reason for that is this global backdrop. While central banks often take credit when inflation comes down, we often have to take into account it's not only monetary policy here at home, but the global picture. And in the city at the turn of this century, the joke was that the CPI, the Consumer Price Index, should be renamed the China Price Index. Such was the impact of China. And when you look globally in the last quarter of a century, there were 4 global factors that drove inflation down. And 2 of those 4 have changed, and 2 of them are still the same. The 2 that have changed, the globalization has been replaced by fragmentation. The world is different. And the other that's changed is the wage share that was squeezed lower of unskilled workers, in particular in economies like Britain. That's now seen a reversal. You might say that's a good thing. Against that, technology and financialization are still combining, and AI will reinforce this to keep inflation low. So in a nutshell, inflation is likely to settle maybe at a higher level than it did before the pandemic, which will make the Bank of England's job harder, and they'll have to work harder to keep inflation down.
So what does this mean about interest rates?
Well, it means
we've given the power of interest rates away to the Bank of England, right?
Yeah. Well, we were
discussing this beforehand.
We were
this is one
actually
of the things that Tony Blair did, giving a lot of power away from Parliament. And one of the first things they did, of course, was that.
That was one of the fashions in economics at the end of last century.
It hasn't been a very successful one could argue.
Well, one could say that the Treasury has an open door into the Bank of England, and the Treasury tends to sort of be in charge of every appointment at the bank. So confidence is important in terms of the eyes of the markets, and that means the central bank not only has to get its policy right, but communicate effectively, and the Bank of England hasn't communicated very well. But coming back to your question on interest rates, the real problem in the last decade, to pick one of the many problems out, has been that monetary policy in the West has been too loose. By that I mean interest rates were too low for too long. There's a temptation to think low rates are a good thing, but low rates can actually cause many problems. And in the last decade, low interest rates, close to zero for much of that period, meant that asset price inflation was rampant.
Houses in particular.
House prices, and that added to intergenerational problems. It meant financial markets didn't price properly for risk. Therefore, it meant that resources and money was not allocated properly. Zombie companies remained in business. Growth companies were not able to attract the money they might have needed. And it led to the pickup of inflation that we've seen in recent years. Now, higher interest rates have combined with an ending of the supply side shocks to bring inflation down. Interest rates are now 5.25%. I think they need to fall. I think they will fall in the second half of this year and maybe into the first half of next year, and probably settle at around 4.5%. I wrote a piece in the Financial Times probably this time a year ago saying that we need to become used to interest rates remaining higher for longer. That wasn't a consensus view at the time, but I think it's now a consensus view. That means interest rates can come down from current levels, but they're unlikely and hopefully won't fall back to the levels that we saw in previous years. But they do need to settle at a level lower than now, partly because when rates were lower, people borrowed, people took out mortgages, and many people are refinancing. Small and medium-sized firms also are being penalised by the tight monetary conditions. So it's about getting that balance right. So for investors and savers, they should anticipate rates coming down, but also anticipate interest rates settling at a much higher level, say maybe 4% if they're lucky, but more likely 4.5%, possibly 4.5%.
Right. So just before we bring Charlotte in on the investment implications of all of this, let's just look at the wider picture. And in America, I mean, we've got a pretty divided country here with an election coming up, but an even more divided one across the pond. Yet the American economy seems to be surging ahead as if politics don't matter. I mean, what's your view of the wider economic picture?
Yeah, well, let me give you 3 numbers. Not that I want to bombard you with too many figures. 32, 62. And 110. What are these? Well, I think these are 3 numbers that help to tell how the world is changing. They're the size of the world economy in trillions of dollars. At the beginning of this century, the world economy was $32 trillion in size. Hard to picture that. The day the financial crisis started in 2008, the world economy was $62 trillion in size.
So nearly double.
And this year, despite the global pandemic, despite the legacy of that global financial crisis, in fact, despite all the problems we've had globally, the world economy this year is set to be $110 trillion, according to the International Monetary Fund.
Again, almost double.
Yeah,
so that's one of our readers has asked about China.
So the question is, why is that? And here in Western Europe, we're becoming a smaller part of that global economic pie. Indeed, in the next 20 years, Western Europe, including Britain, will be less than 10% of the global economy, less than India alone. But what we've seen is that the world economy is growing, but more of that growth is coming elsewhere. The way we need to think about it is to turn the map of the world or the atlas around and look at it with India in the west and America in the east, Trans-Pacific. The Indo-Pacific, that region is where the bulk of growth is coming from. Currently, the global economy is picking up, but to put in perspective, compared to, say, when Tony Blair came into power and the world economy was growing over 4%, and indeed the UK economy was stronger then. Now the world economy is growing closer to 3%, 3.2 to be precise, according to the International Monetary Fund. So the message to take away is, one, there is a structural change in the world economy. The likes of China and America has adopted and changed, led by Silicon Valley. But so the view of the world economy is different. Our challenge in Britain is to reposition ourselves, as indeed the challenge is for Western Europe. The good news this year is that the world economy is picking up compared to last year, but let's not get too excited because the actual rate of growth is far less than we have become used to in the past. And indeed, the global financial crisis of 2008 was a telling turning point. Before that, bring it back to Britain. Before 2008, the UK economy doubled in size, in real terms, take out inflation, doubled in size every 26 years. On our current trend rate of growth, we double in size closer to every 60 years. So Britain faces challenges. Therefore, we need to put all our optimism in context and recognise that the global economy is changing, and that creates maybe challenges and risks, but also for investors and savers, and also for companies, it creates great opportunities as well.
Okay, just one more thing before we bring Charlotte in, which is, and this is a reader who's asked this, about debt levels.
Yeah.
Both here in America, around the world, how much are they going to impact? The huge levels of debt, particularly in America and here.
Global public debt is at its highest level ever. Public debt and also private debt is pretty high, and that is a challenge. Take Britain. We've got 5 options. You grow, you restructure, austerity, let's rule that out. You basically tax, we've already done that pretty much, or you borrow from the markets. Grow, reform, austerity, taxation, or borrowing. In Britain, borrowing is already high, taxation's already high, government spending, this is the big political debate. So you come back to those first two. Can you restructure the economy? No. Can you restructure the economy? And can you grow the economy? That's why we need a pro-growth economic strategy. Everyone says every government wants a pro-growth strategy. They do, but you need to actually actively do it. And it means incentivizing the private sector, in particular, to invest, because low investment, unfortunately, has been the bugbear of the UK economy.
Well, we haven't heard much of that from the Labour side as to how they're going to do that, but that's another matter. Let's turn to that's really interesting. So, Charlotte, let's talk a little bit about this when it comes to advising clients. Now, I know we don't want to get into particular shares, but what aspects of what Gerard's been saying? What are the aspects that you should bear in mind if you're an investor now and you're telling your clients to think about?
Yeah. So, I think just to kick off, I think one really interesting statistic, and we've been bit miserable about the UK, but just to say there are 14 million people who have between 50,000 and £5 million of investable assets. So there's a big community of people who are asking exactly this question.
That's not including houses?
Not including houses.
Between 50,000 and 40, really?
Yeah, and not including defined benefit pensions. So there's a lot of people with a lot of money who really need to be thinking about this.
Yeah, in a country of 60 million or whatever.
That's right.
Yeah.
So one of the things I think is worth just chatting about is, first of all, where does wealth management fit into the overall picture of one's wealth? And I like to talk about the three-pot theory, because I think we all live by three pots, whether we call it that or not. And pot one is your liquid pot. So that's like your current account. It's money going in, salary, dividends, maybe rental income, money going out, theatre trips, nice holidays and so on. Pot three is the illiquid pot. And that is always in Britain, starts with houses. It may start with one house, and it may move into more houses. Then it might be things like illiquid investments, or much more volatile investments, single stock picks that you mentioned at the outset. And that I sometimes call the passion pot, because if we like investing, that's the pot we enjoy doing it in. Now, where Netwealth and where wealth management comes in is what I call pot two. And what we are aiming to do, and this is what I think we as financial consumers need, is to have a group of people managing one's assets across a diversified portfolio of globally diversified across fixed income and equities to drive what I call sleep well returns. And when I think about, what that pot two consists of...
So not too much risk.
Well, so risk...
Depending how much risk you want to take.
So to me, this is all about what you're trying to achieve.
Yeah.
So the key thing to remember, I think, is investing should be goal-based. And remember, too, that investing is a long-term game. So that what we should be thinking about, what the asset class mix should reflect, is what are those long-term goals? Things like, are you planning on school fees? I made a big mistake when I was a partner at Goldman. We had 4 kids. We put them through public school. But I hadn't got round to having a pot two, allowing me to pay for that in massive investment in a way that was sensible. Because, of course, school fee planning, that lasts 20, 25 years, especially if you've got lots of children, for example, or retirement planning. So I think it's really important that you're thinking about this over a long-term period, and you're thinking about levels of risk that match up to what you're trying to do. The other thing, which is absolutely critical, is keeping costs down. And this is one of the reasons that I set up Netwealth, because it's all very well talking about asset classes. People focus on this notion of outperforming benchmarks. That's irrelevant. It's whether you can achieve your goals. And one of the things that will help you achieve those goals is to keep fees down. And I don't know whether some of your readers will be aware, but the regulator has once again had to come in. They produced the Consumer Duty Act that they launched last July. In order that, once again, we're reminded that wealth managers should be treating their clients fairly and providing them with value for money. The upshot of this act is that the biggest wealth manager in Britain, St James's Place, their stock price is down 60% over the last 12 months, because people are putting 2 and 2 together.
Goodness.
And suggesting that the models have to change. Now, I was fascinated, actually. There was a recent article...
And you're not down 60%.
Well, I'm going to talk a little bit about our pricing, because it really, really matters, and that it matters to the financial outcome. So there was an article that was written recently about the fact that St James's Place is not the most expensive provider, which is true. So at 2.2% all in, they presented a chart, and by the way, it's on St James's Place website if people want to go and have a look, and it explains that there are those who cost more. They use examples like Quilter, Rathbones, Brewin Dolphin, and they go all the way up to providers charging 3.2% per annum. So while it may be the case that there are other more expensive providers, what they failed to point out is that there are groups now, and Netwealth is one, that have been going for 8 years. We have a long track record. We can very clearly demonstrate that there are ways to do this in efficient, low-cost ways, where the all-in total cost is 1% lower than the lower end of that chart. Now, if you save 1% every year in fees, for a service that is at least as good, I should point out, that has all of the same human-facing aspect to it and providing the same level of service, that over 10 years, that will save you 14%. Now, so if you have £1 million portfolio, you are potentially giving away £140,000 in fees when you don't need to. So when your advisor rocks up in his new Ferrari, you should go and give him a hug and say, I hope you like my gift. You should be really, really clear about how much you're giving.
That's the amount extra that you're paying, which you shouldn't be paying.
Which you just don't need to anymore.
I was going to say our performance, actually. We track our performance relative to the benchmark, the competition, and we've outperformed in all our asset classes over every time period since inception.
Yeah. That's right.
So if you're sort of me and you're kind of you're a little bit risk averse, you want to hang on to what you've got because you're gambling with other things, and I started the week and I did all sorts. So I don't really want to take too many risks. What's a reasonable these days? Should I be looking to increase by 5%? I mean, I know it's very difficult to put a number on it, but what sort of is a sensible amount that investors should be looking to increase by? To increase their pot of investment, the money they've got in equities and.
Well, so I think that this question of how much risk is a really interesting one. One of the things that we work on quite a lot is people come to us and they want to talk about retirement. Now, this is not directly answering your question, but the point is how much risk to take in order to drive the income I need over what will potentially be a long time. Yeah. One of the interesting things about retirement is people talk about it as a moment. But of course, once you retire, it's hopefully a multiple decade arrangement. And therefore, that money needs to last a long time.
It's like that joke about what are you going to do tomorrow? Well, I'm retiring. What are you going to do the day after? Well, I haven't worked that out.
Exactly. So in fact, when we work on financial plans for people, the biggest risk they see is not taking enough risk. Yes. And actually, this is even more true of women than men. That there's this sense
too risk averse.
There's the potential to be too risk averse. So you have to remember that you're lining up your pot that you've accumulated.
Then it all disappears in fees, and you don't make. I mean, that's the danger. Because the fees still.
So the fees will have that compounding effect. The longer your retirement lasts, the more those fees will eat into your ultimate retirement pot. So it's a really good question, and it's very important to take the right amount of risk for the pot size that you have and the income that you're trying to generate.
Yeah. So if you have £1 million, for example, and you want to. And you want to make as much income out of that as you can. You might be able to get 50,000 if you. That's 5%. I mean, assuming you had £1 million.
Well, so let's talk for a moment about the 7 risk level portfolios.
I mean, I'm only asking this because one of our readers has asked the question just.
Yeah, no, that's right, because there's a sense of sort of what's the right amount of return.
Exactly.
So we run 7 different risk levels. 7 being the highest, which is basically 95% equities, and that has, on average, returned 8.5%.
These are the people who want to take a bit of a risk.
So this is
8.5%.
8.5% for globally diversified equity risk. Yeah. Now that is much less risky than, for example, when I was at Goldman Sachs and I had the single stock Goldman position. So people who are investing in individual stocks, that's a much riskier position than our risk level 7. Yeah. So 8.5% is what we've produced over the last 8 years. For the middle risk portfolio, the balanced portfolio as they're called, 5% is what we've produced per annum, net of fees over that period. So that gives you a sort of sense, I think, of the types of returns you can generate.
Yeah. No,
I was going to say, even though you've mentioned the £1 million, people can come in with £50,000, and indeed we have this network where people can bring in people with less money than that, and their funds are managed independently. So we appeal across the sort of income spectrum.
Well, that's actually been a really nice and exciting thing to have. So I think I mentioned there are 14 million people who have between 50,000 and 5 million. So our minimum is 50,000. That's where we start. But as Jerry said, one of the things we've done is we've created through technology, and we've had this from the beginning, something called the Netwealth Network, where once you're a client, you can bring in, we've just increased it actually to 9 family members or friends into your network. And the reason it's so attractive is because it's actually the aggregate assets which drive the fees.
And they put all their assets together, the 9, or they can do?
But it's managed separately.
It's managed separately. They're independent clients.
But they each have to have 50,000.
No.
So once you're in there, you can.
One person
somebody can come in with
5,000.
Yeah, that's really interesting.
So what's interesting to me is looking back now, it's proven to be very attractive because 75% of our clients are actually in networks. And I think that the real attraction is if I take myself, I'm sort of mid-generation. So elderly parents at one end, young adult children at the other, all in my network. And so they're each able, for my elderly mother, her pension will last as long as possible because the fees are much lower, because she's in my network. Young adult children a whole lifetime, hopefully ahead of earning something, but recognising it's much harder for the younger generation, who again just starting now to let whatever money they have start to grow at those growth rates that we were talking about, but at really low fees, because it's the aggregate assets that drive the fee level.
So just before we move and look abroad a bit, again, this is a reader question about particular asset classes. I mean, I suppose this changes a lot, how much you should have in equities and how much you should have in property and so on. Do you have Is your view constantly changing about that, or do you have a pretty, how you should mix your investments?
I think probably an interesting way to think about that is, let's take this person in retirement again, where they're saying, well, what should my asset class mix look like? And this notion of how much risk to take. One of the things that we see a lot, and I really think makes a lot of sense, is if you have 7 risk levels, let's think about retirement. Right now, there's a pot that you probably want to draw from over the next, let's call it 3 to 5 years. So that pot you would put on a very low risk, because you can't afford to weather the sort of storms of market volatility. But there'll be a chunk of your overall pot that you actually keep on risk level 5 or risk level 7, or maybe a combination of the two, where you're generating those higher returns that we talked about earlier, because that pot you may never touch, and we all know from a tax efficiency standpoint, pensions are very good. We'll get onto that later. But actually, more importantly, there's a chunk of your overall savings that you can keep on relatively high exposure to equities, which is a perfectly sensible thing to do, even if you're in your 50s, your 60s, even 70s, because, as we talked about, this is money that hopefully will last another 2-3 decades. So I think splitting the risk levels in order to, again, suit the particular aspect of how you're drawing from your pot make a lot of sense. The other thing I would say is that financial planning is an important part of this. So it is an aspect of the service that we provide. And I think one of the things we decided is actually we would only charge for it if people wanted it. So we recognise that it's a certain time of life when financial planning and financial advice.
So this is where, when we're talking now, beginning to talk about pensions.
Well,
so that if you're thinking ahead to, how am I going to eke it out over the years when I become a pensioner?
It could be pensions. And retirement, so that's one of the things. But the type of things we talk about, for example, would be drawdown strategy. So how might you sequence your contributions or your withdrawals for tax optimization? Or it might be, what's your income like? Is there a shortfall? And what can be done about that? How may your income needs change over time? Or it may be someone who's slightly younger and they're thinking about, okay, I've got reasonably good income that will last for a while, but I've also got mortgages, I've got school fees to pay.
Yeah.
Help me think about a financial plan that will let me look forward and really make sure that we're doing everything correctly. So I think it's sort of horses for courses, and the way we've tried to develop the service is sort of not force a one-size-fits-all down everyone and force people to pay for things before they need them, but at the same time recognise that, for example, financial planning can be very, very valuable at certain times of life.
And we've got somebody here saying, I'm 62, my modest pension, is it still in some high-risk funds? Is this foolish so close to retirement? But again, you'll say it depends on how big your pot is.
It depends on how big your pot is. So, what is your appetite for risk, your capability of taking risk, and your need to take risk, depending on what you're trying to achieve. But you certainly shouldn't think, okay, I've suddenly reached my 60s and I should put everything into fixed income. Yeah. I mean, the fixed income behaved disastrously as a market, only a year or so ago, and that was unusual that it behaved the way that it did. But more importantly is to think about, I'm 62 and I've still got 30 years that I need this money to be reflecting that.
Yeah. Let's widen the picture a bit, Gerard, and talk a little bit about what's going on in the world. As we mentioned earlier, we've got a lot of elections. I think 40% of the globe are doing elections one way or another this year. But let's talk about America. Presumably, it worries you quite a lot what's going to happen in America. We had a piece in the Knowledge yesterday about, possibly even could fracture so badly that you might one day be looking at another civil war. I don't buy that myself, but it's a sort of tricky scenario we're looking at, and you must have to take all that into account.
Yeah, well, in macroeconomic policy terms, America has done incredibly well in recent years.
And you think it looks like it's going to go on doing well?
Well,
the debt thing we talked about.
I was going to come back to that previous question. Government fiscal policy, government spending and taxation. America has basically put its foot on the accelerator in recent years. Now, obviously, it's a choice between Biden and Trump. The markets seem to think it could be Trump. The expectation in the markets is that regardless of what you think about Trump as an individual, he probably will be better organised if he were to be president this time. Indeed, in Davos in January.
So if you're an investor, it's probably better to have Trump than Biden.
No, I'm not saying that. The markets are saying that Trump is in the lead. But take Davos in January. Jamie Dimon, the head of Chase, was basically talking in very positive terms about a Trump presidency. while he wasn't taking political position, I think he was trying to tell the audience, it's not suddenly going from a light switch from good to bad, or however you define it. I think the point that the markets are trying to say is look through the politics and what does it mean for policy. Monetary policy should not change that much, but you might see some of the individuals, for instance, Biden might keep the same head of the US Federal Reserve, their central bank. Trump likely will change him or could change him. Fiscal policy is where the difference comes in. Biden has the IRA policy, which is a very proactive. Trump could easily be relaxed in fiscal policy, but move it more to lower taxes. Then on the green agenda is where I think the big change will be seen. President Biden has been very constructive towards the green agenda. President Trump is unlikely to be. So there will be subtle differences that could manifest themselves. Internationally, though, the big change is both in terms of economics and geopolitics. Economically, in the first term, President Trump basically took on China through a trade war, which at the time caused serious challenges. Now, even though when Biden became president, he had a whole series of executive orders to reverse aspects of Trump, one area he didn't really touch was the relationship with China. And recently, President Biden has put tariffs on goods from China. So the trade tensions are a big worry, which adds to this likelihood of fragmentation of the world economy. That is, firms onshoring, or what's been called friendshoring, no longer always putting production in the lowest cost.
And this is a trend which is likely to be accelerated by Trump.
Yes.
I mean, on the green point, I was talking to one of Trump's former officials who still advises the account, and her view is that obviously Trump has to negotiate with Putin, but before he does, he's going to want to switch the energy tap on, the oil tap on as much as he can, persuade Saudi if possible to push more oil out, like as Reagan did in the 80s, because the only way you get leverage over the Russians is by trying to drop the oil price.
You're right in terms of, but that
so I don't think he's going to be so worried about the green agenda.
There's two different issues here. On the green agenda, no, I agree with you there. I'm on the advisory board of the Grantham Research Institute on Climate Change and the Environment here in the UK, which is probably one of the world's leading groups on the green agenda, and indeed I sit on the expert panel in Washington to do with it. So I think the moves towards the green agenda are the right one, but you can't go from a fossil fuel economy to a renewables economy overnight. But you certainly need America on side in that move. But you're right in what you say. I think it also leads into the geopolitics, because we have a G3 world, but the G3 world is different to the G3 world we might have talked about 20 years ago. The G3 world now is Group 1 is America and its allies, which includes Britain. Group 2 is China and its allies, which includes Russia. And third group is the most interesting one. It's the non-aligned group, as they're called in Britain, the middle ground powers, the likes of India, Nigeria, Brazil. Big economies.
Sort of the global south.
The global south, I think, is not the up-to-date way of viewing these countries, but they're very much powerful economies, really developing, albeit in different ways. They don't want to be seen to be in America's back pocket.
Aligned.
And they don't want to be seen in China's back pocket, but they're not necessarily taking sides. But as we've seen also this year, the electoral cycle, we began with Bangladesh and Taiwan, predictability there, but in the last week we've seen in India and in South Africa and in Mexico very different dynamics. And in India, President Modi or Prime Minister Modi did not do as well as expected. So when one looks at the global politics, it's changing. And when we come to the second half of the year here in the West, whether it's Europe immediately, Britain in a few weeks, or America in November, the incumbents are under threat, because not everyone has shared in that economic success, and it's about the vision for the future.
I think that's right. I think governments which were incumbent anyway during the pandemic, they're the ones which are around the world. I mean, they're the ones that are suffering.
And we saw this in the 1970s when we had high inflation. That was the last, well, not the last time, but that was a period of political change and instability. And it, therefore, if we take Britain's example, the 70s then triggered significant economic change on both the left and the right. In the 70s, when the Conservatives were in opposition, Sir Keith Joseph and Margaret Thatcher came up with their monetarism, and eventually privatization. Labour, it was only after they lost in May 79 that they came up with their alternative economic strategy by 82, 83 under Michael Foot. But the point is that inflationary 70s caused political change and then led to economic change. Here in Britain, as in other countries, the inflationary backdrop, the cost of living backdrop is causing political change. We try and factor this into our thinking in terms of how it impacts policy, how it impacts markets. And we don't take political sides. You, like playing cricket, you play it with a straight bat. You try and envisage what this means. But this sort of environment, when we saw it in the past, albeit in different circumstances, led to significant political change leading to significant policy and economic change. We haven't seen that policy or economic change, but that could well be the thing that comes next in the next 1, 2, 3, 4, 5 years.
Charlotte, so what are the, listening to Gerard, what are the investment implications of some of this that's going on abroad? How much do you have to factor all that in when you're balancing people's portfolios and adjusting them?
Well, as we discussed, I mean, what you can see is that the markets start to preempt some of this and express their concerns, and you start to see assets that would typically not be correlated with equities, so for example, gold and commodities being potentially areas of safety. The US dollar has
and gold's done well, hasn't it?
Gold has done very well recently.
So
we have some in our portfolios as a measure to protect. I think, more worrying.
Marion Somerset Webb, who I started, which is odd for somebody who doesn't know anything about money, I started a magazine called Money Week After Week, which Marion Somerset Webb.
We know Marion very well. She was a non-executive director at Netwealth until last year.
She's always been a huge fan of gold. You say the word gold, and she's
yes. Well, she'll be listening to this podcast with extreme interest, I'm sure.
She'll be thinking, what on earth am I doing?
But I do think, without wanting to sound too glib, that markets have an extraordinary ability to correct. Let's just go back to, for example, 2020 and a global pandemic with people dying at rates that we hadn't probably ever, none of us have seen in our lifetime. And sure, there was a tremendous down move in the markets in March, at the end of March. Within 3 months, now this is just one specific example, the market had corrected entirely. So, financial crisis, again, you have what was an extreme global financial crisis with all sorts of good reasons for why the markets traded off in 2008. And actually anyone, most of us would have felt there will be some knock-on effect over the next N years. And in actual fact, again, the market's corrected over time very clearly and positively. So markets will tend over time to keep paying investment returns. And so one of the things I would say is that
partly because there's nowhere else for money to go.
Well, it has to go somewhere.
It has to go somewhere. And also the media always exaggerate everything.
That's right. And there will be a point when it goes down and someone will suddenly say buy. And then once that voice gets louder, the metaphorical voice, since there's fewer phones around these days in terms of trading, that's when people start to get back on and invest. And of course, you need to put the money somewhere. So one of the things, for example, when we think about the UK elections coming up, and I know that one of, there was a reader.
To move on to this,
I think we'll move on to it in a minute. But I would certainly say, don't try to time the market. Don't do anything, over hastily, where you're panicking because of what might happen. Because I think over time you just need to, ride some of the potential waves and earn those returns that will be delivered.
And also, very much so, internationally diversified is vitally important in this. And you also need to be challenging the market. Even though the markets are often right, they're not always right. Take, for instance, Japan. Japan had been in the doldrums for so long, people became used to saying Japan is in the doldrums. Now the Japanese economy has turned the corner and suddenly is becoming incredibly attractive for investment.
Yeah. Marion was always very pro-Japan.
Yeah. Yes, she was.
Take China as well. You mentioned about China earlier. China's growth rate this year is probably going to be 5%. Because it used to be double-digit growth rates, people are saying, China's slowing. It is slowing, but at 5%, China still adds an economy the size of Poland, which is the 21st biggest economy in the world, adds an economy the size of Poland this year. In contrast, India, people are saying, is doing really well because it's growing at 7%. But when you take the population growth of India, I would argue India's in the growth recession. I'm very positive about India, but it's not generating the jobs needed for its younger population. So you need to look at these things in context. And what we do is try and challenge the thinking and actually say we need to be internationally diversified. But
there's not an area of the world where you'd say you're less keen on than you used to be in moving, I mean, America or Asia or Europe.
The UK economy might be a good prelude in. We're positive about the UK market because the UK is undervalued.
Yes, the market's undervalued.
Yeah, the market's undervalued.
And has been for quite a long time.
That's right. And it's the global message. When one goes to America or to China or elsewhere, often the image of the UK is heavily influenced by the media that they read. And we can go off in a different tangent there. But the point is that it offers an opportunity. In the last week or so, sterling has rallied. But in terms of the world economy, the real issue is how Western Europe repositions itself against not just the backdrop of a geopolitical environment with Russia, but about the need to rise to the challenge of other economies across the globe. And that leads on maybe to the UK.
Well, yes, let's talk about the UK and the possibility of a Labour government and what that means. I think Danny Finkelstein said that Labour's slogan was Britain's in a terrible mess, so let's make sure we do absolutely nothing about it. And his point being that we've really heard very little as to what Labour has, and maybe very wisely so. We have a piece in the Knowledge today, a piece in the FT by Janan Ganesh saying the last thing we want Keir Starmer to be is bold. Because bold in these terms means left wing, which means doing all sorts of, it doesn't actually mean, it means living left wing and imposing all sorts of new taxes. But what do you think? When we're almost certain to have a Labour government, will it make any difference? And if so, what?
Well, when Labour won in 1997, the UK economy was growing strongly. The world economy was growing far faster than now. Debt in the UK was somewhere around 35 to 40%, and there was the peace dividend. Now the UK economy is far weaker. The global backdrop is more difficult. The room for policy manoeuvre is limited, and the peace dividend has been replaced. Now, the financial markets are taking the view against this backdrop, and given monetary policy being run by the Bank of England, there's little difference in macroeconomic terms between the two major parties. Now, that might well be the case for the next 12, 18 months. But beyond that, then there is likely to be a significant divergence. And one saw that in the debate this week. Once one digged a bit, despite having similarities about the immediate macroeconomic picture in terms of fiscal and monetary policy, further ahead on government spending and taxation, and on other areas there were differences. On the face of it, Labour has said that they will change planning reform. This is one of the policy levers that most economists would agree has to be pulled. But the
houses
building more houses.
I think it's something that only can be done by Labour. I can't see the Tories ever doing that.
So that might be a positive.
Might be a positive.
But it needs to be done. That's the issue. And then the challenge is Labour is saying that workers' rights will change. When you say workers' rights, that sounds constructive. But then at an event we were at last night, the business people there were very concerned indeed. So it's not just what they say, it's what actually happens in practice. So obviously the issue, there are many different stakeholders, but one of the important lessons from the last few years is that you need to keep the markets on side. And you need to keep the markets on side, but clarity about what you plan to do and credibility about the longer term. And I think that's very much on Rachel Reeves' mind, as it has been on Jeremy Hunt's mind in the last 2 years. It's how you then move beyond that. But the UK...
And your worry is moving beyond that you will see taxes rise and you will see more regulation and you will... Is that what it is? Or do you think they could go in a positive direction and we could get reform of the NHS or reform of planning?
Okay, I would say that the UK economy needs to have a triple arrowed approach, and you need to have a bullseye with each arrow. One arrow is monetary policy and financial policy needs to be not only keeping inflation under control, but ensuring that the city helps serve the UK economy. The Macmillan gap was first identified in 1931 about banks not lending enough, and we still have it. The second arrow is about fiscal policy, and that comes very much into the heart of the political debate. The third arrow, is where I think we're likely to see differences between Labour and the Conservatives. It's about the supply side of the economy. And I lead the listeners and viewers to look at it in their own terms. But what we need to get right is all the I's: investment, innovation, infrastructure, and incentives. And in incentives is about taxes not being too high, and it's about regulations being smart. And then on top of that, you then get the other I right, which is inequality comes down. Obviously, immigration, we never talk out in the UK, and therefore that tends to be taken up by the extremes. But that also is part of the debate because it matters for housing and for other areas. But it's about the supply side of the economy. So you need to have a pro-growth economic strategy. And both of the major parties, as we saw through the debate this week, have differences about the longer-term outlook. But for the financial markets, the view is that the immediate outlook will be little difference between the two of them. And then coming back to your question, I think, yes, it then starts to diverge thereafter.
So, Charlotte, taking that, what do you think then? What should we as viewers, listeners, be thinking about either ahead of the election or just afterwards, given what Gerard says about the first 8, 10, 12 months? I mean, are you basically saying they shouldn't? There's nothing really to be done in the next month or so, and nothing should be done too hastily, or what do you think?
Well, so we're naturally getting a lot of questions from clients about this,
the investment implications,
about the impact that a Labour government would have, particularly when it comes to tax changes. One thing I think it is worth mentioning is that it's very unlikely that new regulation would be retrospective. So, people shouldn't expect that something dramatic that's, we'll talk for in a moment, I think, about the lifetime allowance, for example, which Labour have said they will reintroduce. But we need to think very carefully about what is retrospective and what isn't. So I think, Labour have said they're not going to change income tax nor national insurance. So there are 3 areas that are perhaps worth talking about. One is pensions. And this is a really huge area. It's a big area for a new government. It's where the money is. And really, I think it's likely that they will have a major review before they do anything dramatic. They have confirmed that they're going to reintroduce the lifetime allowance, which is the cap on pensions below which you can accrue your pension tax-free.
That's a good thing.
The Conservatives had abolished it completely, and the cap had dropped all the way down to $1 million. Yeah. So when Labour say they'll reintroduce it, what they haven't said is at what level. And I think now common thinking is that it's going to be no less than 1.5 million, could even be 1.8 million, which was in fact the highest point the cap was ever at. And therefore, it may become a bit more of a moot point in that case. The other thing is, though, nobody thinks it can be reintroduced within the next 12 months. It's taken long enough for HMRC to get behind the abolition of it. So it's not going to happen straight away. I think in general, people should get their money into the right shelters, one of them being pensions. The caveat is possibly going to be about taking money out of it again. So Labour never liked pensions freedom that Osborne introduced, and it's just possible you could see a Labour government starting to add new restrictions on how you access your pension. Or, you have to have a minimum income secured, or they increase the age that you can access it. But generally, I would say you want to actually action those shelters and get into them. So you can currently pay £60,000 into a pension, and you can also carry that unused allowance forward from 3 years. So people should be
taking advantage of that?
Well, potentially, yes, if they've got the spare money, I would say to put it in. The other thing that's just worth thinking about in the context of pensions is it's possible, again, that Labour would change the amount you can take out tax-free. So they might reintroduce a high cap so you can keep putting money in, but they might separate out the 25% tax-free lump sum that you're allowed to take out, just to add a little bit of complication to things. Capital gains tax, we're often asked about that as well.
I was going to ask you about that, but, and a reader's asked of you what radical inheritance tax or capital gains tax changes would a new Labour government be likely to introduce in its first term?
I think this is really interesting because I think it is safe to say that capital gains tax is never going to be lower than it is right now, so 20% if you're selling equities, for example, or taking gains. There is chat about capital gains tax possibly being raised as high as matching income tax. There's no confirmation that would happen, but I think the direction of travel for capital gains tax is one direction only, and that is up. And the reason I think it's really worth thinking about in the context of investments is because I come across people quite often who are hanging on to often single stock positions, sometimes inherited, where there's this sense of I don't want to pay the tax. And my view is celebrate the fact you have a gain to tax, pay 20% while it's still only 20%.
Yes, rather than hang on, and you might end up losing much more of your gain because you're paying much more. Absolutely.
Exactly. So the only
Makes
reason
sense.
you should hang on to it is if you think this is a stock that is still going to go up dramatically. Otherwise, I would say take the gain, pay the tax at 20%, and reinvest the money in probably something more diversified, which has less pin risk, as we would say, that you get in a single stock. I think then the one other area is IHT that you mentioned. It's not really a huge driver of revenues, so it's less the point about revenues. I think fewer than 5% of estates are actually affected. But of course, it's the social implications of the wealthiest being the ones who are affected. And it does come up often. So currently, estates that are worth up to £1 million for a couple, which is split between £650,000 of assets and £350,000 for property that's worth less, or up to 2 million, and passed on to children, that is exempt.
That's exempt, yeah.
And then, of course, what lots of your readers and listeners will be thinking about is this 7-year rule where you can start to pass money down the generations. And if you outlive 7 years after the significant gift, then that is tax-free.
Yeah.
And so it is possible that they will change the rules.
Yes, there's a question specifically about that as to whether one should be making gifts to one's children because of that.
Yeah. So as I mentioned, having young adult children, that's something we are naturally thinking about as a family as well. We come across people all the time who are trying to work this out. And I think that, as I said, these are unlikely to be retrospective. So if you're in the process of thinking about next generation planning, then that's the right thing to be doing. However, I would caveat that with make sure that you know how much you need and that you have the right amount for your own older age, retirement, before you start giving money away in a panic. Because the last thing you want to do is end up, in your 80s and suddenly you discover that you don't have enough money to get you through your older age. So again, that's the sort of thing which we work on with clients. This is where taking advice actually can be really, really important. So if people are trying to think about this pre-election, come and chat and let's have a look at what does the pot look like, how much can you afford to give away, and then how would you do that? Absolutely.
I was going to say one that links into one of the areas that Labour might focus on, which is about allocation of pension money in the UK more to the UK assets themselves. A sovereign wealth fund, for instance, has been talked about.
Yeah.
I testified to Congress and Senate on this back in 2009-10 and actually did a note for the previous Labour government, I think, on this. And the issue is this, that countries that have sovereign wealth funds that are successful have a natural resource often that feeds the sovereign wealth fund. The issue then and now in the UK is how you fund a sovereign wealth fund. Where does the money come from? And then, of course, where does the money go? But underlying this is the need to boost investment, whether it's public or private investment. Obviously, the challenge in the UK is that you want it to be private investment, and if you just focus on public investment, it has lots of other issues.
Yes,
you want public investment if it feeds private investment, but a sovereign wealth fund is one of the areas, and trying to get UK pension funds to put more of their assets into the UK market is another aspect of this, which often meets a big pushback in the city where people naturally talk about their fiduciary responsibility to maximise the return for their shareholders. So ultimately, as long as we make the UK competitive with the right policies and encourage the private sector, then naturally people will want to put their money here. So it's about getting the balance right.
Absolutely. Okay, well, we need to be wrapping this up shortly. So I've got two questions. The second's from one of our readers, but the first one is really, what are some of the biggest mistakes that you see people make when it comes to managing their money? I mean, I'm sure you see some. Charlotte, what do you?
I think probably it's trying to time the market. There's this sense sometimes that, I just need to pick the right stock or the right manager and everything will be fine. And, it'll go up and I'll sell it and make the money. People forget that when you try to time the market, it's not one decision, it's two decisions. So if you think back to the pandemic and the volatility that we saw, then even if you had been right to sell the minute you heard about the pandemic, would you have known that you should be buying again at the point the market was at its low? Yeah. So I think that's one of the biggest mistakes. It's almost trying to be too cute. I'm a big believer in keep it simple. It's a medium to long-term thing. Be invested, globally diversified, and just make sure you're earning the market. And don't try to be too clever.
And don't panic or jump on a bandwagon.
Correct.
All the things which I do. In fact,
there we are.
So this is from a reader, so it's much the same. And what are your 3 golden rules for someone on their investment journey? Or they could be negative or positive.
Well, so I like to talk about control the controllables. Because, as we know, markets are going to do whatever they're going to do. Inflation will be whatever inflation's going to be. Longevity we can't control. So my 3 rules would be invest and stay diversified. Use the available tax wrappers, pensions, ISAs being the 2 best tax wrappers are both for yourself.
Take advantage of those and don't forget to. Yeah.
Absolutely. For yourself, your spouse, potentially your children, and keep costs down. And if you stick to those...
Which is what Netwealth does.
That's right.
Keep costs down. Keep costs of your management down.
That's right, with no compromise on the surplus you get. And if you follow those rules, you will achieve the financial goals that you're setting out to achieve. Or at least you increase the likelihood in every respect of achieving those goals.
Anything you want to add to that, Gerard?
I don't think that can be better.
No. Well, thank you both so much. You've given me a lot to think about. I mean, I think it sounds very sensible, all that advice. And the tendency people like me have, we don't, we dive from one thing to another. Any share I have invested in, it goes straight down, so I can't possibly manage my own money. So I think most of us are looking for someone who can do it for us, who's got a sort of sensible view. So thank you so much.
Thank you
very much for having us.
Great to speak to you.